Hello, this is Mike Gallagher from IDEAglobal. I'm Director of Research, and I want to run you through the latest IDEAglobal medium-term foreign exchange views. Just quickly, as you go to the sort of summary table to kick off, I think the key trends that we're looking for. First of all, in terms of the dollar, the next 3 to 6 months for the remainder of 2014, we think are going to be pretty tricky. We will see a little bit of a dollar appreciation against the European majors and additionally against commodity currencies, but it's a degree of dollar appreciation. The reason for that is that the Fed tapering isn't necessarily going to turn into tightening expectations on that kind of timescale. There'll be a radically different picture, we think, in 2015, where Fed tightening will come to dominate, but at least for the remainder of 2014, that's why we're sort of looking for just a gentle rise in the dollar, euro dollar to 134 and then 133 in 3 and 6 months. And that's the broader sort of background. Behind that, just to highlight, if we actually look at global liquidity, then global liquidity this year, if anything, is actually going to be a lot better than last year. One of the big themes last year, and you can see it round about here, is that the ECB undertook radical shrinking of its balance sheet as the LTRO funds rolled off. This was actually so large that it actually cancelled out the growth seen from the Bank of Japan and the Fed. 2014 is very much going to be different. We've still got tapering, but we've still got the Fed balance sheet growing. We don't now think that the Bank of Japan will actually undertake a new QQE, and we're likely to see the pace at some stage in late 2015 decrease, but at least through the middle of 2015 we expect the Bank of Japan to continue to be pretty aggressive in expanding its balance sheet. The new TLTROs plus the S&P sterilization will expand the balance sheet for the ECB ahead of the end of the year, and overall we expect the G3 balance sheet to increase by 12%. This is critical to supporting riskier markets around the world and is a critical driving force in allowing a low volatility environment. This ongoing liquidity expansion should mean further expansion in terms of the S&P, and it will continue to see an increase in frothiness in the high yield market in the US, where we've seen quite a surge in covenant light loans. We do eventually think that the Fed will move from tapering to tightening, but this is likely to be a process that the Fed only get to outline in essence once we get into 2015. The Fed are likely to be cautious about being too premature in terms of tightening, and indeed they may well prefer to be a little bit tentative, knowing that eventually they're heading to probably around a 3% Fed funds rate, not sort of 2% as some people have suggested, in 2018-19. So does it really matter if the Fed start summer 15, spring 15, or autumn 15? Well, in the bigger picture, it doesn't, because they're quite sort of conceivably, we're talking 75 basis points per annum in terms of Fed tightening, which is actually a pretty slow Fed tightening cycle. And 2015 is all going to be about adjusting to the tightening cycle, the start, the pace, and the eventual new normal rate. What this does for the dollar, we think, is produce a significant re-rating of the dollar. The dollar generally on a trade-weighted basis is pretty low. We think that as we sort of see the Fed moving towards the exits and undertaking preparations for the first tightening move, that the market will radically reshape its medium-term expectations, not as violently as 1994, but sufficiently well to differentiate it versus the ECB and the Bank of Japan, which will be very much in easing mode. For us, this produces quite a significant uplift between sort of 6 months and 12 months in our forecasts. So for example, we've got euro dollar going from 133 to 125, a very choppy dollar yen in the next 3 to 6 months, but then up to 108. And then the commodity currencies, a gentle rise in the dollar in the next 3 to 6 months, followed by a more pronounced rise in the dollar. 117 on the Canada, 85 on the Aussie, 80 on the Kiwi. One question that has been asked is there a real risk that the yen could see a further short covering squeeze? Well, this graph is quite sort of interesting and illustrative. The red line is the actual dollar yen value. The second line here is actually the relative Bank of Japan to Fed balance sheet. And what we've seen really from 2012 and then during 2013 is dollar yen running ahead and anticipating very expansive Bank of Japan policy. In fact, it's only really by spring of 2015 when the Fed have stopped expanding its balance sheet and the Bank of Japan is still expanding, that we then get to a relative balance sheet that's consistent with current levels of dollar yen. Our core view is that we're going to be stuck between sort of 100 and 103 in the next couple of months. But it is actually feasible that we could still see a technical breakdown. And it's not inconceivable given this situation. The other issue is, can the market genuinely see sort of a weaker trend in the euro? Well, if we look at euro dollar, there is sort of quite a strong case on a longer term basis that the interest rate spread between Germany and the US is a good leading indicator of the euro dollar trend. And certainly the current level of euro dollar is inconsistent with those broader trends, never mind the US 2-year pushing higher through the course of 2015. The big thing that makes the euro somewhat different and why we don't necessarily like the euro as a trade on a lot of the crosses is that the eurozone current account is going to be at sort of 3% of GDP all the way through 2015. And if you look at the experience of Japan, when you had that kind of current account surplus, it didn't matter if you had bad economic news or actually even deflation. It didn't actually sort of change the currency onto the defensive. And I think we sort of tend to feel that the euro will weaken against the dollar, but it's predominantly a dollar story, and that the euro on a cross against most currencies will not see sort of properly defined trends. Our third key point would probably be sterling. We do think that the UK will move ahead of the Fed, most probably November 14 through to the February 15 period. It's not so important in the longer term, when the Bank of England actually take the first step, because the bank, like the Fed, is articulating the position that the tightening cycle is going to be a new normal tightening cycle. We're not going to a 5% base rate in the UK. The Bank of England are looking at a bank rate of 3% in the period 2017 to 2019. And what that tells us is that the tightening cycle is probably 75 basis points per annum, which is a very leisurely pace for the UK. We're normally about 125 basis points per annum in tightening cycles. So it'll be a lot more gentle. So the bank can get away a little bit with being a little bit late, because then they can follow through with a couple of rate hikes in 2015 and set off the gentle trend through 16 and 17, indeed into 2018. Um, but the key, I think, here is that we are heading towards 3% or so over that timescale. And what we're likely to see is a widening interest rate spread, and that is very powerful on euro sterling, as we sort of highlight in this particular graph. So one of our key sets of medium-term forecasts is that we like sterling. So where we do see, and this is a sterling story, we do see sterling strength generally across the board. We are looking for 77 on 3 months, 75 on 6 months, and then eventually 73 on euro sterling. We actually think that sterling Swiss is probably actually a better trade. You will have noticed just below here that we're looking for the Swiss franc to gradually weaken. Now, this gradual weakening can actually sort of bring us, we think, to the 125 area on a medium-term basis. And the reason for that is that outflows are likely to accelerate over the next couple of months. And that's a combination of Swiss multinationals increasing their foreign direct investment flows and Swiss banks increasing their lending overseas. Both have been relatively subdued since the financial crisis, and with the healing in the G10, we think that will pick up. Just to re-emphasize that point, if we look at the level of euro Swiss, and then indeed we look at the 5-year EU banking CDS, and here we've got it inverted, the yellow line. The easing of stress in eurozone banks has not been accompanied by an associated depreciation, and we think that can be the case. And then just finally to round off, if we look at the stocky, we think it's a question of near-term weakness, and that near-term weakness is really sort of surrounding speculation that the Riksbank might have to be more aggressive and to consider unorthodox policies to control the low level of inflation. I think our take on that is that while that speculation can endure for the summer, the reality is that the Riksbank are not necessarily going to be that aggressive. With growth being quite reasonable, we think that the response is likely to be measured from the Riksbank, and through time the underlying fundamental strengths in Sweden will show through. We think that the Euro stocky, eventually heading to 875. We also like Euro NOK. We don't buy into the idea of the Norges Bank easing, and we think that the kind of re-rating of balance sheet strong countries, which has been a secular process, can actually benefit both the Swedish krona and the Norwegian krona right throughout the remainder of 2014 and into 2015. If you have any questions, then please feel free to contact us. My email address is mgallagher@ideaglobal.com. Thank you very much. Bye.